Happy evening to all participants virtually present here. On behalf of SIRC of ICAI and Investors Awareness Committee and CSO Committee, I wholeheartedly welcome you all to today's session. Today's session is in our continuous endeavor towards educating the investors and to create an awareness among the investors regarding capital markets and to enhance the ability of investors to understand broad developments in the country having bearing on the corporate sector and the capital market, and to educate the investors on the rights and responsibilities and to make the investors aware of grievances handling mechanism and different agencies to be approached for redressal. So, to do a light on the topic, we have with us an eminent speaker, Ms. Vijayalakshmi Yanmantram Madam. Before handing over session to our speaker, I take this opportunity to briefly introduce her. Vijayalakshmi Ma'am is currently working as a partner at Sri Krishna Capital, Chennai, and she's a proprietor in Sri Krishna Capital, Chennai. And she was served as insurance consultant at LIC International Bahrain from 2000 to 2004. And she served as a secretary and president Multimedia Pentafloor Software India in 1994 to 1996. And she also served as an assistant secretarial services Kaushik Chemicals Limited India during the period 93 and 94. She has done her BSc Mathematics, and she's a PhD diploma in Computer Science, SSI India, and she's a certified financial planner from FPSP India. And she has done her certification courses in MASM India, MS Distributor Certification, and Management Program for Women Entrepreneurs, IIM Bangalore. And she has conducted financial awareness program at Apollo Hospitals, United India Insurance, and she's also conducted free spoken Sanskrit classes. So with this very brief introduction, we once again wholeheartedly welcome Ms. Vijayalakshmi Madam to this session. Ma'am, kindly take over the session, ma'am.
Thank you. First of all, namaste to all and very good evening. So coming to the presentation now, as she told, so I'll go straightly to the slide, right? And then in the introduction slide, I'll get started after. Yeah, nice. So good evening to one and all. Yeah, as ma'am introduced, I am a partner of Sri Krishna Capital. So at Sri Krishna Capital, we are doing mutual fund distribution business. It was initially started in 2005 as a proprietor firm, and by 2009, my husband joined with me, but he refused to convert to partnership. And then finally, I made him to agree, and by 2015, materialized and made it as a partnership firm. Though he was actively involved from 2009 onwards, then he told, let it continue as proprietorship. But I was fortunate to have him. So he is Mr. Satyanarayan Yanmantram, and he has got a wide knowledge in this field. Primarily, I started this mutual fund consultancy mainly to have knowledge about the mutual funds, as we had investments in the same. So now let's move on to the presentation, and I requested my husband also, Mr. Satyanarayan Yanmantram, to share his views before the conclusion of this session, and he'll be addressing you. And once again, glad to address you all, and very good evening. First, let's move on to financial planning. Financial planning is very, very important, right?
I'm sorry to interrupt. Ma'am, excuse me. Screen sharing is not turned on. You need to turn on your screen sharing button.
Oh, sorry. Excuse. Screen share is not done, right? Webcam.
Third button, yeah.
Yeah.
Now it's visible. Yeah, now it's visible. Please continue.
So financial planning is very, very important to each and everyone. So right from layman to the topmost executives, right? So it starts with cash flow management, day in and day out expenses, all those things, and debt management. So you are all experts in this field, so no need to explain further. However, today I will be touching the basics, right? So today I will be having a glance of the basics, though you are financial experts in this field. So debt management primarily deals with all debit card, credit card management, home loans, and all those things, which I need not go in details because you are experts here. So education planning, insurance planning, retirement planning, and investment planning, all those things which has to be taken care by each and every individual in his lifetime. And at last is the estate planning, and which is very, very important, and tax planning, which is your cup of tea. Now, when to start financial planning? So should I start now? Most of the people, what they do, only after reaching 40 years and after having kid, then only they start thinking, oh, if my child is going for a higher education, I need to save money now. Or for marriage, I think it's time that I should decide. But the beauty is, it has to be done prior to avoid any kind of stress. The earlier, the best. Even the first salary, if you start investing, it is the best. And even more in our North Indian families whom we have as clients, you can see as soon as a child is born, so they open an account, bank account immediately, and they start investments also. So that's the way they do, and they are successful in their money management. So let's have a sample idea here. So Mr. X, he started investing at the age of 35 with a monthly investment of 15,000 rupees. Now here we have taken retirement age of 60, right? Till 60 is going to save. That is, his investment tenure is for 25 years. So if he invests like in this pattern, he'll be investing a total amount of 45 lakhs, and the amount which he'll be having is 4 crores. And Mr. Y started investing at the age of 25, that is 10 years prior, and monthly investment is only 5,000, that is 1/3 of which Mr. X has invested, and he has invested for 35 years. So total investment is only 21 lakhs, but the amount which he'll be getting is nearly 5.6 crores. That is nearly 1.5 crores more than Mr. X. And here you can see nearly 24 lakhs lesser than Mr. X investment. So here time plays a vital role, and it's because of the magic formula, compounding, seventh wonder. Sorry, eighth wonder. And power of compounding. Let's see, suppose if you have invested 10,000 rupees for 5 years at 6%, and 10 years at 6%, 15 years at 6%, 20 and 25 respectively, at different percentages like 6, 9, 12, and 15 rate of return. During a tenure of 5 years, your 6% return would have given you 6,90,240. But during a tenure of 10 years, 6% yield would have given you 16,32,643 rupees. Even if you are invested at a rate of return of 15% for 5 years also, you would have got approximately half amount, which is 8,73,000. You can see 8,73,421 rupees. So what does it mean? Time in the market is more than timing the market. Agreed? This is just an overlook of how we people tend to spend. Food and beverages, transport, others like miscellaneous, housing, clothing, etc. And energy, health, information, communication technologies, education, financial services, personal care, and water utility. Here, food and beverages occupy the most, 31%, and transport, 13%. Others like miscellaneous, it comes to 12.86, and housing 11.8. Almost all these constitute for nearly about 60 to 65% of our expenses. So inflation is a major criteria, right? So why is it major? I need not explain to you, but let me have a word. Like, because of inflation, even the corpus, the ultimate goal amount changes, right? Today, if you require 30 lakh rupees, and due to inflation, it will get more and more high, and it will not be the same. After 20 years, I need 30 lakhs. It will not be constant. It will change, because today's requirement of 30 lakhs after 20 years, it will get inflated because of the inflation rate. So inflation is also a curve, and it's a dynamic figure. It goes on changing. So it was at 4.23 in April 21, then 6.3, etc. And at last March 2022, you can see inflation at 6.95% per annum. And now at April, it stands at nearly 7.79%. The most interesting asset class, loved by all, is nothing but the gold, right? So let's have a look at the gold chart. So you can see 1973 February, gold was 16.78 rupees per gram. Okay, and (2012) May, it's a nearly 2008.1.55, and July 20, it's 4,400, and now May 24, as of now, 4,654.47 per gram. So now a small arithmetic calculation you have done since 1973, because when you say is it as an amount, 16 rupees which I have invested is nearly a week before, like 4,531. So it appears to be quite big, but percentage wise, if you take, it's 12%. And for 10 years return, you will not believe that it has given 5% return. Because being an asset class, it's also tend to be subject for market risk, though there is no disclaimer. Now let's move on to the land price. Now we are having a glimpse of various asset classes which we are familiar and which will be normally investing, right? Now, this is the data which I have collected from people orally, right? And Tinagar, it is 9.51, 4.45, and 1.49. Yeah, 1.83 and 1.49 during a period of 10 years. But whereas in suburban, it has given good, like Nanganallur, here they have given very fantastic return of 18.34% since 95, and within a span of 18 years, they have given 25.63% return, and within span of 12 years, now they have given 11.89%. So suburbans normally, like they were in the process of developing, so nevertheless their return would be quite attractive. Whereas in the developed places, the scope of moving gets slower. Next, the major asset class, which is trembling all, liked by all, feared by all, is the share market. Yeah, you can't get any top-notch people like top 10 billionaires or the richest person, whomever you take. You can't find even a single person who doesn't have shares in his portfolio. Only with land and jewelry and cash, he will not be topping, and he will not be the richest, definitely. So that's the magic of the capital market. That's the share market. And predominantly, share market has got its ups and downs, and because of which people are scared of. And most probably, if you see, media is also very much interested to publish the news whenever there is negative. There is a bloodbath in the market. That's the top news, right? So, and even though it gives some good news, it misleads most of them. But because when Sensex has moved to its top, people get elated and go and purchase at higher cost. And when they say that bloodbath, it arises their fear more and more in their minds. Only the person who know the market, how will it be, they are able to participate in the market and make money out of it. And thanks to education that has been inculcated during the recent times, and most of the SIPs which used to get stopped before prior whenever the market used to fall is not happening, so that people are becoming more literate about the market. So here we can see, as we know, the major fact why I should vote for share market, the major revenue which comes for government is only from taxes, as you all chartered accountants are very well aware. And the taxes arise only once there is profit. And once there is profit, then the share prices tend to rise, which leads to the rally of the share market. But whatever be the macro or micro factors, whatever is it, it affects the share market immediately. Whether there is no proper cultivation, then it affects the share market. If there is a political news, it affects the share market. If the political news is outside India, it affects the share market. Interest rate fluctuation, everything. Now let's have a look at this. This is an interesting slide which I like because it covers almost all the journey, like major events during the journey in the share market, where it started. Sensex started with a base value of 100 during the year April 1st, 1979, and after that it crossed 1000 marks 11 years after its launch. Now, and then we have seen the Rajiv Gandhi assassination, early 90s, Harshad Mehta scam, Mumbai blast, 1993. So that time, 12 places blast occurred at once. It was a huge massacre. Then we can see Kargil War, 1999, unexpected fall of NDA, UPA coming to power, global financial crisis, and Commonwealth telecom scam, etc. And then Ketan Parekh scam, terrorist attack, technology boom, and Narendra Modi coming to power, demonetization, and GST implementation, and PNB scam and ILFS crisis, and then corporate trade cut and return of NDA to power, coronavirus, very, very important one. All those things are the major events that had happened in the market so far. And let's see, from 1979, it started with a base value of 100, and within 40 years, that is 2019, it touched the landmark of 40,000. So, spectacular journey. Now, coming to share market, as you very well know, share market, if you don't choose the right thing, though we know that the best asset class will be the share market, capital market, because if you invest today, the maximum which can income that can arise out of the same asset class will be the share market predominantly. And when there is a fall, there can be nothing also of which you have invested. So what it requires? So it requires expertise in this field. So it requires professional management in this field. I want to participate in the share market. I want to have I want to have a participation in it, but I don't know how to do it, and I don't have the time to spend to do the research for it. There we have got the option of coming to the our venue favorite one, mutual funds. Here mutual funds, they pool the asset of the investors, and then they invest in the securities, generate the returns, and then pass it back to the investors. And this is done by none other than the professional fund manager. So what is its worth? Normally, if some person is giving 50 lakh rupees, he'll be collecting, 5 crore he'll be collecting, and 5,000 rupees he'll be collecting, and invest the same. And according to per unit price, units will be allotted to him, and according to the market movement, that amount will be returned back to him. NAV will also keep on moving, and then the market value is passed back to him depending on the units held by him. So the famous example which we give for mutual funds is like a slice of pizza, which friends used to share according to the proportion they have invested. Now, net asset value of mutual funds. So here the major difference between the share market and the mutual funds, instead of saying share price, here we term only some jargons here, like a share price which we say in share market, here we are going to say it as a unit price or a NAV, and here we don't call it as shares, but here we term it as units. And the calculation of net asset value is when like this, funds asset minus funds liabilities by number of units outstanding. There's an example given here. So market value of securities held by the fund is 60 billion. Accrued incomes is $8 billion. And cash and cash equivalent, $10 billion. Accrued expenses, $1 billion. Short-term liabilities, $2 billion. Long-term liabilities, $12 billion. And total number of outstanding shares, it's 10,000. There is erroneously dollar written there, so we have to remove 10,000. So total funds asset comes to 78, except for the last three, that is long-term liability, short-term liability, and accrued expenses. That all account for funds liabilities, which comes to 15 billion. So the net asset value will be 78 billion minus 15 billion divided by 10,000. Nothing but $6.3. So what are the types of mutual funds? Broadly, let's see how is it done. By structure, open-ended and closed-ended. And by investment objective, it's divided into equity, debt, money market, and gold. Equity investments are divided into large cap, mid and small cap, and multi-cap sectoral. Here, debt is divided into gilt, broad, long-term bond, short-term bond. Money markets are divided into ultra-short, liquid, and gold is gold with underlying ETF. So what are large cap funds? Depending on the market capitalization. So funds are, let's say the major three classifications, right? So major three classifications, first company till the 100th company, it is termed as large cap, and mid cap is 101 company, 101st company till the 250th company is mid cap, and from the 251st it is termed as the small cap. So what might be the market cap? So as of now, it's a dynamic figure, keeps on changing. Once the market capitalization keeps on changing, this figure also keeps on changing. But as of now, approximately it's 20,000 crore and above come under large cap, and 5,000 crore and less than 20,000 crore come under mid cap segment, and less than 5,000 crore comes under the small cap segment. Let's have large cap companies at a glance. Reliance, 221 billion, Tata Consultancy, 162, HDFC, 100 billion, Infosys, 82 billion, etc. So Hindustan Lever, LIC, ICAI, Bharat Airtel, etc. they come under large cap companies. So we have so far heard about large cap. So don't we need to see how they are going to perform? So here I have considered, for the purpose of comparison, almost all the companies which existed, all the schemes which existed for 10 years that I have taken. So you can see Aditya Birla, Axis, Canada, DSB, Edelweiss, Franklin, HDFC, ICAI, IDFC, Invesco, Kotak, L&T, Mirae, Nippon, Quant, SBI, Sundaram, Tata, UTA. Almost majority of the companies I have taken here. So let's see the returns. 10 years return, you can see 14.9, 14.7, and 15.13, etc. So the lowest return you can see as 10.79 with the given data here, right? The data provided here, and so the highest return being the 16.77 and mediocre being say 12. So we have generated minimum average. You can see that we might have generated return of about 12%, right? And for 1 year return, you can see 7, 7.35, 1.29, even negative, and then even 0.84. See, 0.84 has grown till 12. But if you're scared and if you're going to break the investment within the first year, which we people, generally retail persons, they tend to do. The amount which I have invested has not given me even the bank interest. Why should I hold it here? Might be I might have entered into a wrong asset class. So let me quit. And they lose this opportunity. If you are going to invest in PPF, so at most for 8.5%, right? At most, you are prepared to wait for 15 years tenure. 15 years, okay, without doing anything. But here, when you are going to get minimum of, like you can see, if you are here for 10 years in equity, you can expect around 12% return. A decent return, isn't it? Now SIP, suppose what is SIP? Month on month investing. Some people, they mistake debt. Being chartered accountants, I know you might be very well aware of it, but still the common mistake which people make is, okay, so is SIP, they think that SIP is different from mutual fund and it's a separate asset class itself. So if you are, instead of investing as a lump sum at one go, if you are going to do it as month on month, then we tend to come for this SIP. So generally, when do we go for SIP? SIP is a disciplined habit. So once I start earning money, then I can opt for the route of SIP, which has to be done by each and everyone at the younger stage at least, so that your income minus your SIP, which is a small saving habit, should be your expense. Why SIP? Because when you keep the asset class which fetches you more decent return without any expertise and monitoring and shortcuts, is none other than the mutual fund route. And once you start saving at the early age, it gives you fantastic yield, and you can fulfill your goals without any stress. That magic work is done by SIP. Without knowing how it's saved, you will be automatically saving the amount. That's a beauty about SIP. And when you know the market is damn low, and you can't predict the market, right? And when you find that it might not proceed even more lower than this level, then also only if you have lump sum, that time you will be able to invest it. And other thing is, when you are uncertain about the market conditions, how it's going to move, which way it's going to move, that those times you can select SIP route. If market falls further, you're going to accumulate more number of units. If it's going to move further, then per unit cost is going to raise. So if I have invested in SIP instead of lump sum, what is the return that would have been generated? So let's have a look at it. Here I have taken only few funds, and this one I have taken from Advisor Coach. And here Axis, ABSL, Kendra, ICAI, Blue Chip, 3,000 invested. That is for a period of 2010 till 2022. 120 installments. So 120 into 3,000, 3,60,000 rupees has given you a return of 7,03,548. So 13% return, 12% return, 13, 13, and 13. So around 12 to 13% the return here also, which is recurring. So mid-cap stocks. Mid-cap stocks, you can see a few mid-caps. Nippon Life Asset Management, Rise, Nuvoco, Chemiplast, CDSL, and Fine Organics. Let's see the performance of mid-cap companies. Here, ABSL, as I told previously, which have been there for 10 years, almost all the funds, majority of the funds are quoted here. ABSL, Axis, DSB, Edelweiss, Franklin, HDFC, ICICI, Invesco, Kotak, L&T, Nippon, Quant, SBI, Tata, and UTI. And here you can see the return. 10 years is 15.87, 19.9, 17.43, 20.16, etc. And here, on an average, the lowest, if I'm going to take, it's 14.86. Here, it's not guaranteed or assured return. Okay, so I think you know that, but I'm reiterating the fact that I don't assure here the minimum return of 14% or the maximum return. Only thing is, we are seeing the performance, how it has been done so far, to have a glance of how big cap performed. That's it. To have an idea how it has performed. Now we can see it has performed nearly minimum of, if you see, it's 40.86, it's nearing 15, it's quite decent, and maximum 20% return it has done, right? Small cap companies, Reliance Infrastructure, GET&D, Strides, Vakrange, Wockhardt, and Gujarat Piper. Few of the small cap companies, let's see. Here, if you see small cap in 10 years, all themselves, many of them are disappearing, right? Because they have got a track record up to 5 years, right? So ABSL small cap, Axis small cap, DSP, Franklin, HDFC, ICICI, Kotak, L&T, Quant, SBI, Sundaram, Union. So yeah, you can see the return 15.62, 21.57, 20, 17.91, 16, 13.98, 25.38, and 17.35. Here, small cap companies, if you see, once there's a lot of scope for these companies to grow, so the returns generated would also be good and decent. Only thing is, when the market is falling, no one will be there to buy the small cap companies. So the fall will also be more, and the return will also be more great compared to the asset class, other asset classes. ELSS, tax saver. So ELSS schemes, as you might be well aware, under ATC exemption, like NSC, PPF, insurance premium, here up to 1,50,000 rupees. All put together. Either you can invest full amount in mutual funds itself, or along with others. If you put, you can invest up to 1,50,000, and in that, ELSS also forms a part of it, and it has got 3 years lock-in period. 3 years lock-in period for ELSS schemes, that's tax saver schemes. So let's see the performance of ELSS. So ABSL, Axis, as I told, here also Kendra, DSP, Edelweiss, Franklin, HDFC, ICICI, IDFC, Invesco, Kotak, L&T, Nippon, Quant, SBI, Sundaram, and Tata India. All those data points have been taken from value research. So these are taken for comparison from value research. So 13.92, 14.65, 17.42, 15.44, etc. are the returns. So it has given a decent return here. You can see near around 13%. It has given majority of the cases. Okay. And in 1 year return, you can see negatives. And some funds, they have performed 10.73 in 1 year. Some funds, they have performed 3.96 negative in 1 year. So depending upon the stocks they have selected. But once you come for this 10-year tenure, you will be able to make a decent return. So always the equity asset classes should have a comparison of 10 years. Only if you are able to afford to stay in the market for 10 years or you don't require the amount for 10 years, we have to come for the equity asset class, or else it will be very difficult. Suddenly people come and say that I don't require money for 10 years, definitely. And once they see the fall in the market, they get scared and they say that no, after 1 year itself I have to take the money out. Whereas in the HNI's behavior is very, very different. Once they see the fall in the market, they add the money and they tap the opportunity. So money grows with them. Most probably, like, people will be very curious to see, like, among all the caps which has performed good. So why don't we have a look? Like, so in 2007 you can see micro cap ranked first, small cap then gave good returns second place, mid cap third place, and large cap fourth place. So most of the times which occupied the first place is micro cap. See, we can see that nearly 2, 4, 4, 5, 6, 7 times. The name has been changed to small cap. Now, if you go for micro cap, you will not be able to find it because micro cap has been changed to small cap now. Since the risk is more, the return also will be eventually more, and they top many of the occasions. Likewise, the fall will also be more in their journey, right? We have to prepare for it. And next which has performed is still 2021 this data, right? So next which has performed is large cap, 3, 4, 5 times large cap has topped, and 3 times mid cap has topped. Sometimes we need to know, okay, which cap will be performing better, will sectoral funds they do better, so which one should I choose? And if I know that, then I'll be watching for that person who is recommending me only the top funds. Let's see how the top funds were. 2002 JM, so they topped, and 2003 Franklin, and then comes a contra fund topped into 2004, and Sundaram, all those things. And here in 2017 you can see small cap SB small cap top, flexi cap 2018, 2019 focused equity, and quant small cap. As I told, since small cap is exposed to more risk, most of the occasions small cap has done, but here also it's a rotation basis. It's not the 2010 small, 11 small, so 12 small, 30 small, 40 small, it doesn't happen. Most of the occasions small cap has performed because of the risk it has taken, but nevertheless there is always sectoral rotation, and the funds also, here asset management companies, the companies like ICAI, Sundaram, all the asset management companies also, it comes as a topper under rotation, and it's not the same. So you can't see 2021 now quant small cap is top, so now I'll go and invest money, right? Because by 2022 it might change, and 2023 it will be different. Now let's see some minor differences, like some words they sound alike, like multi-cap, flexi cap. So let's see what's the difference between them. So multi-cap means at least 75% you should be in equities, and the following manner, like 25 in large, 25 in mid, and 25 in small. Whereas in flexi cap, it should be 65% of the assets should be in equity and equity related, and there's no threshold. So here the fund manager has got a free hands. Here, if you go for multi-cap, it's more concern of safety. Flexi-cap is more concern of the returns and bagging the opportunity, right? And arbitrage funds. Arbitrage funds, what do they mean? We are curious to know, right? So generally, they generate returns by buying and selling simultaneously in different market and taking advantage of the differential prices. That's what arbitrage mutual funds do. But only there is differential price, it will generate the return. If there is no opportunity for differential price, then return will be eventually low. But here I have given it for an example, few arbitrage funds and 5 years return. No, but it's not the thumb rule or the base rule, right? I don't mean to say here that arbitrage will be giving you 5.83% per annum, 5.9% per annum. It doesn't mean that, but an example of how it performed during a 5-year return. And here it keeps on fluctuating. As I told, it might give you a return of 3%, 2%, etc. if there is no chance of having differential prices. And it comes under equity category. That's a major advantage. So it comes under equity and doesn't come under debt fund. And SWP, why do we know SWP? Because sometimes I will save the amount, but after saving the amount, I need to have month on month, I need to have some amount out of this as which I invested, or I might retire, or I might take a break from my career, and I would like to have some withdrawal portion of it, which I will save long before. So can I do it? How to do it? That can be done in systematic way by SWP route. Now I have taken an example from Advisor Coach. So here we have taken Access Mutual Fund, Access Short Term at lump sum amount we have invested for 10 lakh rupees on 2010, and here the withdrawal amount I have done from 2012 May till 2022 May. So month on month I wanted to withdraw 10,000. So how much was the return generated? Here we can see Access Short Term. So 119 installments, return is 7.38%. So I don't mean to say that all SWPs will give you 7.38% and not more than. And I will not say that minimum it will give you 7.38%. You rest assured. It is not that. It's just an example of how the SWP works, and I don't recommend any scheme or an asset management company here. These are considered for examples. Now STP. What does STP mean? Systematic transfer plan. When do we do the systematic transfer plan? Like most of the times, if there is volatility in the market, what do we do? Now we might want to have the investment staggered, right? So that time, if you say that okay, next month you bring me 1 lakh, and after that you bring me 2 lakh, all those things, it will not work, right? So whenever there is a fund handy with you, like 10 lakhs or 20 lakhs, you can put the amount in a liquid fund, and from that, it doesn't again mean that it has to be done into the liquid fund and it has to be transferred to only to the equity fund. Can be done in any fund, from any fund to any fund, right? So generally people park it in a liquid fund. So instead of holding in SB account, etc., it's better to have in liquid fund. So from that, money gets transferred from month on month or quarterly, depending upon their choice, and then the return is generated. Let's have an example here. Here ICAI Pro Liquid Fund, here we have invested, and one time, and now the investment amount is 2 lakh, and from that transfer amount is 10,000 on 5th of every month. So starting date is 5/7/2015 and end date is 19/5/2022. So let's see transfer of scheme, that is ICAI approved liquid fund. So number of installment comes to 21 installments, and total amount transferred 2,10,000, and after transfer the units remaining is 13.95, and value as on date when it stopped, like it's 3,333, and the total return which has been generated here is 7.61. Again, I need to tell that it's an example or an illustration scheme taken here, and it doesn't guarantee you any returns, and it doesn't vouch you to purchase any schemes. It's purely for educational and knowledge purpose here, which we are holding this example. And they have got it transferred to equity and debt fund. Here, the scheme return is 14.19%. You can see the value invested is 2 lakh, and then current market value is this plus this. So the total return is 13.33%. Now we are coming to debt fund versus a favorite FD, right? Most of the people, the two senior citizens, have gone only of FD, right? So how about holding in the FD? Okay, let's assume that you are having the same rate of return in FD as well as the debt fund which you have invested. Okay, and 2 lakh and 2 lakh, that's a period of 3 years. So the fund worth at the end of the tenure is 2,45,000, and now there is no indexed cost benefit available in indexation benefit available in fixed deposit schemes. As you know, the long term for debt mutual funds is greater than 3 years and they are subject for 20% indexation. So the index taxed amount, taxable amount is 24,528 here, because cost of indexed cost comes to 2,20,000. So 2,45,000 minus 2,20,000 is 24,528, whereas there is no indexed cost available here. So the taxable amount is 45,000 and 20% on this is 4,906. So after tax, you can see the profit is returns after tax is here 40,000 and approximately, and here 31,000. So approximately 8,500 rupees we are getting more here, even though they generate similar kind of returns. Now let's move on to the cutoff time. So what about the timings? Like if you are going to purchase the liquid funds before 1:30 and the amount recent, according to the recent regulations, only if the amount is credited, then the units will be allotted, right? So liquid funds before 1:30 purchase request is done and credit has been done, then the NAV of the preceding day units will be allotted, or else after, then or else the NAV of the same day. And in debt funds till 3 p.m. it's a NAV of the same day, or after 3 NAV of the next day. Equity funds till 3, if it's received, amount is received, then NAV of the same day or of the next day. And for redemption here, even for liquid funds, the cutoff time is 3 p.m. only. Before 3 p.m. Then NAV of the same day, and after 3 p.m. is going to be NAV of the next day. Now, once we are going for planning, then we need to know how much is the amount that I want to have, right? So just for a curiosity, let's see the calculations. See Mr. X. So Mr. X is now only 30 years old, right? And what he wants is annuity. Annuity, when does it start? Like after retirement, he wants to have it. So he assuming that he is retiring at 60. Okay, but he is expected to have life expectancy by 80. So modern science has increased life expectancy. Now risk of life is gone. Risk of living longer is there, right? So we have to provide for medical, food, and all those things if you are going to live longer. So financial well-being is very, very important nowadays. So now annuity has to be given for 20 years, and inflation, I have assumed it to be 7%. Interest rate 8%. Is it possible? Why not? If you are going to have a mix of mutual funds and all those intelligent, smart investing. Okay, let's assume that Mr. X has done smart investing and he has invested in an instrument which is going to yield you 8%, or else you can't sustain, right? So let's think that amount needed at 60 years for him is 20,000. So according to it, if I make the calculations, the corpus required for him will be 43,81,000 at the age of 60. But now on, he wants to save it, but he can't save it at once. He's asking, just now he has started earning and all those things. So how to save if I'm going to save it month on month? So merely by parking amount of 2,107, approximately 2,000 rupees, he'll be able to reach his goal, right? But if he fails to park this 2,000, which is nothing but a dining expense of 2 times, giving party to the friends, he'll be struggling at their retirement. Now let's have a key events at a glance in which affects the equity market. Whatever happens, it will affect the equity market, right? So here we can see Russia-Ukraine war is prolonging. We do not know when it's going to end, right? Now we can see oil prices that have increased, and then commodities like thermal coal, steel, wheat, logistics, everything has hiked. So once the war comes to end, also we have got a trade. Now we are getting at a discount price from Russia oil, I believe. So in case there is a stoppage of war, then discounts, all those things will be gone also. So other thing is FPI has pulled out 1.22 lakh crore of rupees. And March 7, you can see the Sensex has touched 52,842 points. Right, from 60,000, it has come down to 52,842, and Nifty was also down to 15,863. And US Fed rate hike was done on 7th May, so they have increased 50 bips, and rupee depreciation has occurred due to it, and there is also higher import cost. Inflation has hiked up everything. Economic crisis in Sri Lanka. So what's the impact on it? Then, being neighboring country, it's our duty to provide us the support to the neighboring country. So food, medicine, refugee crisis, like it didn't happen so far till now. Large amount of refugees did not pile up, but we don't know what will happen tomorrow. All those things are threats here. But once you take as an opportunity, you can see that tea industry, textile, all those things got diverted to India. So other thing, repo rate of in India increased to 4.44%, and due to higher inflation costs, rupee depreciation, all those things, GDP projection, ICAI has rated down the GDP projection for, to 5%, because globally everywhere there is a problem. People are pulling out the money, and here you can see FIA is selling 1.62 lakh crore in 5 months. There's a recent news published today. 1.62 lakh crore in 5 months, pushing half of the Nifty stocks to bear market. Here we term bear market is if the stocks fall more than 20% from its peak, then we term it as the bear market. So these are the key events. Here what we should do? Should we run away from the equity market, or what action should be done? Only thing is slow and steady wins the race, and you should have the perseverance, patience to take the fruit. So what we have to do? Kindly make use of this opportunity, and if you can, you invest the money you don't want in near future, which always happens. That's a mantra we preach for the equity market. But here we reiterate strongly, do not miss to invest during these periods and the market is quite low. And park the money which you don't require in near future. So normally, let's see what are the mistakes we make. Age 20, there is no proper saving and avoiding investment. As I told, 2 times dining expenses if you keep without you go on for party, but you can park some amount for your savings for your life. And age of 30, you can say unorganized savings and buying flashy products. And age of 40, avoiding investments. 40 you come, then you have much of loans. And age of 50, using retirement savings for other purposes. So are you making these mistakes too? But nowadays, we are happy to see younger generations, especially our friends' children, as soon as they receive the first salary, they are coming and they are making a small provision for the investments for the future. Very nice to see this. I think the youngsters would develop this habit and they would enjoy each and every phase in their life. And nice speaking to you. Thank you.
Thank you, madam. So, sir will continue his presentation on this one.
So, yeah. So, sir, Mr. Satyanarayan Yanmantram will be continuing here. Correct.
Yeah, please. I will share the screen. This video is not visible actually.
Yes, stop this one.
Screen sharing is stopped now. I took back the rights actually. Sir, can you unmute yourself, sir? Hello.
I am unmuted. Can you see the video?
No, sir. Video is not visible to us,
Okay,
sir.
sir.
Actually, it's no. If possible, you can join. Shall I share the screen that is the PDF that is shared with us, sir? Um, can we continue? If you're there. Yeah, now it's visible, sir. Just rename it and I will continue. Sir. Under file menu, it can be renamed. For screen sharing, I will share the. Can you unmute yourself, sir, please? No. No problem,
You
sir.
can please share it, sir. Okay, absolutely fine. It's Namaste. I am Satya Yanmantram. Actually, you know, I am also one of the partner in the Sri Krishna Capital, and very happy to be here. And it's a privilege and honor to be with the allied crowd to take IAP program. And we conducted various IAP programs in the last 10-15 years, and really very happy here. And the main thing what I want to mention here, I will talk about that screen what is presented maybe after 2 minutes. Why the normal investor, why the common man in India is not make money from the capital market? That is the main question. I will throw this question to all the audience, maybe those who are, you know, 30, 40, 50 years. Why? How many of us made money from the capital market? Because every single capital market, including India, excluding Japan, maybe Japan for the last 3-4 decades, we don't make money from Japan because maybe it is well developed, maybe we are not making. But you see, India as a country, we made more than 14% CAGR from the Sensex. How many of us made that type of return from the capital market by investing in index fund itself? Someone has made. The main reason being, you know, taking the short-term call for the long-term investments. Maybe what will happen, all the investments, maybe it is a real estate, whether it is a gold or a capital market, whether it is a mutual funds or a direct equity, it is all a long-term asset class. But what is happening in the here, because of the liquidity, higher liquidity in the capital market, suppose if you see the real estate, there is no liquidity. Liquidity is very difficult. Not today, on many occasions. Only in the bull run you may see some liquidity, but it is not comparable with gold or capital market. And common man, that is a salaried class or middle income group, our majority of the saving is going for the insurance investments. I'm not insurance. Normally I say insurance supposed to be the funds. It is not an investment. Investment is separate, insurance is separate. And the second thing is the first, maybe 2030. So probably if you see the last 25-30 years, whoever bought house in India, apartment I'm talking, not the land, maybe they paid the EMI of 25 years, the return what they delivered, excluding the interest component, I will just exclude the interest component, across India, anywhere, maybe it is in Assam or in Chennai or maybe in Bombay, apartment delivered below 10 to 11%. That's it, maximum I'm talking. I did the research back testing for the Andheri or maybe in Baliganj in Calcutta or in Chennai, various places. I collected the verbal information, what is the apartment price, what is the price today. But everyone invested there. After that, we stuck there for 20-25 years. Because of that, and because of the investments in insurance, investment is the insurance premium alone could be roughly 18 to 19% of the saving of the common man. And fixed deposits, which is like running into lakhs and lakhs of crores in India, fixed deposits, which will give us somewhere 5 to 7% or maximum 8% last 25 years. It delivered only 7.75% return, that is pre-tax. But we are happy there. We will hold the fixed deposit probably for rollover, maybe 1 year deposit, 3 years deposit, 5 years deposit. We keep it for longer duration. Assume madam mentioned about the indexation benefits and all. Very few people using them, very few people. The common normal investors are not using them. But that is Warren Buffett says, deferred taxes, we are all becoming richer. We are deferring, we are not evading. Somebody put the bond fund 50 lakh rupee. If it is in a bank FD today, it could be after paying 30% taxes, expected return of 7%, maybe today 1.3 crore. Maybe if it is same in the banking and PSU fund or a short-term fund, after 20 years, if you see, which is 1.8 crore after paying the taxes, that itself 50 lakh rupee difference. Just example I'm giving you, which is not a small amount, which is a very big amount, even those who are conservative. But really what happens, if you see the last 1 year bond return, especially the short-term or any fund, it gave you only 3.5%. By seeing that, we will try to take it out. I normally say debt is dangerous. Debt is dangerous means why I say the bond is dangerous. Our expectation is 5 or 5.5% or 6%. Even if I get 0.5% lower, that means 10% I'm getting lesser. That means very big. So we assume that, bond will give only 3%. We will exit the bond. Every one of us having the fixed deposits. For me, our personal portfolio, I don't have any deposits because, if I have deposits, I have to pay 30% taxes. So I'm differing through the bond funds. So what is the risk involved in bond funds? If I have a 1 crore deposit with State Bank of India or Reserve Bank of India floating rate bond fund, bond, it is like, it is not traded every day. So I have to wait for 7 years. After 7 years, I get my 1 crore from RBI. If I want to sell, I cannot sell. At the same time, if I invest in listed bond, which is traded every day, maybe 1 crore, when interest rates are coming down, my 1 crore will become 1 crore 1 lakh. If interest rates are going up, my 1 crore will become 99 lakh. If I hold till maturity, probably I will make the same return what normal investor is making. So even if you are investing in a bond fund, investment period supposed to be 3 to 5 years. If you need the money in 6 months or 3 months, see only the liquid fund or overnight fund for less than 1 month and all. Even liquid fund will give a negative return. Yes, we have seen in the past also during the Fed easing happened in 2013, 40-45 days, NAV movements are not there at all. Is it bad? It is a market end of the day. Maybe, if Europe, when the Fed easing happened, banks closed. They were not giving a few pounds only, they were giving 47 pounds every day they were giving. We can't take it out. So that is the situations we have seen in Italy. We have seen in very developed places also. When crisis happens, we don't know what will happen. So personally, we keep everything in bond fund. Like, recently Russia, 10 days, market closed, or 15 days market closed. What will happen? That is a thing we have to think if you are investing everything in the capital market. My suggestion to have a well diversified investments. That is very, very important. Diversified in the sense, if you have 100 rupee, have a proper asset allocation. If my son's education, I have to keep it separately if I want to pay the school fees. Daughter's education, we have to keep it separately. For emergency fund, we have to keep separately. After that only we can buy gold, or we can buy land, or we can get into the capital market. First, we have to keep for, very, very important, all our professionals, take a term insurance, pure term insurance, at least for 20 to 30 times of your annual income. I don't know, out of 400 people are here, how many people are actually insured in the sense, correctly insured. Maybe everybody is having insurance policy. Maybe we may have 10 lakh rupee policy, 20 lakh rupee policy. We may pay 50,000, 1 lakh rupee premium. But how much what we got last 20-25 years, average return what we got is only 5% or 5.5% from the insurance investments. If you take the pure term insurance for 1 crore at the age of 25, you may pay only 9,000 or 10,000 rupees premium. That is actual insurance.
Sir, sorry to
Insurance
interrupt.
are only 1 year medical claim policies. You should have the
Okay.
proper medical claim policies. Then only what will happen, you know, if any problem comes, nothing should come. Even if it comes, whatever you saved in last 10, 20, 30 years, maybe if you saved 1 crore rupee or 50 lakh rupee, if any medical emergencies, you have to pay 5-10 lakh rupee. Then what will happen from your corpus you have to pay. Then automatically your wealth will come down because any disease will come without knocking our door. So you have to have the plan for your insurance, very, very important. I will suggest you only the pure term insurance. You know very well, and you take a pure term insurance at least 20 to 30 times of your annual income. And medical claim policies, and one more is a top-up policy. Top-up policy is very, very cheap. A basic policy, you can have a family floater or a individual medical policy for 2-3 lakh rupee. Top-up policy maybe 10-15 lakh rupee. The premium will be very, very low, which is available in the website that you can also vouch for it. Both are covered. Keep some emergency corpus, maybe from 12 months expenses or 24 months expenses. Keep it as emergency corpus so that our health will be very good. Even something happens, we can run our family for 1 or 2 years without worrying anything. That time only, you know, once we don't have money in our hand, we try to take the decisions. It could be not good for our career. So my suggestion, once you have some corpus for 2-3 years, then automatically we know, you know, even nothing I have corpus that I can run my family. So if we go to the screen now, here it is one-time investment. One-time investments means, for example, somebody invested in large cap fund, Aditya Birla large cap fund. That is the first column. Everybody is visible in the screen, sir?
Sir, sorry.
Screen is visible. Okay, fine. So if you see somebody, I request somebody to scroll when I ask, actually, not now.
Yes, sir.
Suppose, for example, if you see the large cap, madam mentioned large cap, mid cap, small cap. What is large cap? 80% supposed to be in the top 100 companies of India. Top 100 companies. That is large cap, 1 to 100. Mid cap is 101 to 250. All others are all small cap. So large cap, total market cap of India, it was 280 lakh crore, maybe, you know, before the market correction. If we see today, maybe market corrected from 62 to 53,000. Maybe assume 2 lakh 80 become 2 lakh 60,000 crores. The same thing will happen in these schemes also. So somebody invested 1 lakh rupee 1 year before, that is in 2020. Market moved up after post-COVID. Most of the countries are bleeding, but India is doing very good. Even the tax collections and many things we are doing very good. Some sectors are still not yet doing, especially in hospitality, in resorts, all those things not yet doing. It is a cycle, it will come back. We never seen 100 years, did not see COVID. It came now, the vitamin C crisis. So 1 lakh invested in Aditya Birla 10 years before, today which is 4 lakh 65. Whatever scheme I am discussing, whatever the equity name I am discussing here, it is only for education purpose. It is no solicitation. I'm not asking you to buy or hold or sell. It is only education session. So somebody bought 5 years before that Aditya Birla large cap, that is a frontline equity, name is frontline equity, today which is 7 lakh 83. Suppose what is the slide is shown here, every year 1 lakh rupee. There is a systematic investments. Suppose somebody investing every year 1 lakh rupee, what is the value now? Sir, have you changed the screen, sir?
Just checking it with this slide or this one.
Okay,
which one you mean?
Go back to the other one, sir.
This one? Year
Yes,
and is compared with this one.
Yes, sir. This one only.
Yeah, I'll keep
here.
it
This screen shows you somebody invested lump sum of 1 lakh rupee 1 year before 1 lakh, as of 31st December 2021, 1 lakh 24 today. Assume something comes tomorrow, market crashes 30% or 40%, 1 lakh 24 will become 84,000 or 90,000. That is subject to market risk. Suppose flood came to Velachery, 2014 was 8,000, 9,000, 1 crore rupee for 1,000 square feet. But 2015 December or 2016 after the flood, people are not ready to buy that. So flood comes to the land occasionally, but in the capital market, some news will come, some flood will come, some volatility. So market is always irrational. Somebody is selling, somebody is buying. So assume tomorrow market falls 20%, 1 lakh 24 will become 95,000 rupees. Suppose somebody invested 10 years before 1 lakh rupee, that become 3 lakh 83. Aditya Birla hybrid equity. Hybrid means 65% equity, balance will be bond. 3 lakh 83. What will happen now? Market falls 20%. This will also fall to 3 lakh 83 will become maybe 3 lakh rupee. If you see the Franklin India blue chip, that is a large cap. Somebody invested 1 lakh rupee 25 years before. It is today 1.18 crore. That is 1 crore 18 lakhs. Somebody invested in HDFC top 100, which is 68 lakh rupee. Assume today market falls 50%. What happened in subprime? Subprime was 20,000 Sensex. Post subprime it become 10,000. Market corrected 50%. Most of the schemes also corrected 50% plus or minus. Assume tomorrow happens at subprime, maybe 1.18 will become 60 lakhs. Suppose assume I put your RD for 25 years, 25 lakh could become 60 or 65 lakhs at the rate of 6% or 7%. But here, any money what we are investing, which we don't need for immediate future, maybe at least 5 to 7 years, I will say. Don't invest in the capital market. Don't invest in the gold. Don't invest in the real estate if you need some urgent requirement. But normally what happens, especially in the capital market, when markets are going up, we try to invest. My suggestion, please avoid that. Have a dream. You have 10 years, 15 years, 20 years, have some allocations in the capital market so that you can see the very good return. And I will share this to you. You can see. I will show the second one, the mid cap. If you see the mid cap means 65% supposed to be in the mid cap category, that is 101 to 250 stocks. The balance could be large cap or small cap, anything. In the mid cap category, what is the SEBI requirement? 65%, large cap 80% in large cap, in mid cap 65% in 101 to 250 companies. The balance can be in large cap or in the small cap. If somebody invested in Franklin Prima Fund 20 years before 1 lakh, which is 75 lakhs now. Suppose if market corrects within 1 year, 40% fall means 1 lakh will become 60,000. We are afraid. So ignore all the short-term volatility. Every fall is an opportunity to buy. How many times market corrected? More than 20 times in last 25 years. Not even 8 times, less than 8 times, more than 20%. Whenever market corrected 20%, maybe in next 6 months to 24 months, market came back. You can see historically, 2000.com, Ketan Parekh scandal in 2001, 2008 subprime, 2013 Fed easing, and 2020 recent COVID. Even market corrected, people thought everything gone, that's it. People liquidated that 12 months, we were seeing the negative flow continuously from 2020 April to February 2021. They were keep on redeeming the funds. You can see the data available in the website, Money Control or wherever. People, normal public is keep on redeeming, and they started to put the money back when market, started to go up 45, 50, 52. They started to put the money. Again, now from 62 market, it came to 52 or 53. People try to take it out. That is not the way, we do in gold, we do in real estate also. Here also, we have to follow the same logic. And I want you to go to the other slide, other PDF. That is a systematic investment. So this is somebody, I don't have the lump sum. Where to invest lump sum? Maybe, out of my profession or out of my employment, I can say only 1 lakh rupee per annum or 2 lakh rupee per annum. Similar to that, actually, Maybe somebody, bought a apartment for 20 lakh rupee. Maybe they paid EMI of more than a lakh for the last 20-25 years. Assume similar to that. I wanted to participate here. I want to allocate some 10-20% to the capital market, balance to the other asset classes. Something like that they saved last 10 years or 15 years or 20-25 years. For example, you can see the large cap. Somebody invested HDFC top 100. Last 25 years they invested 25 lakh rupee. The current value every year 1 lakh. Assumption here is December 31st they invested 1 lakh rupee without checking the market up or down. Every 31st December I'm investing 1 lakh rupee. So which is 4 crore plus today. What we paid is only 25 lakhs. The same thing if you see the Franklin blue chip, that is a Kothari Pioneer before, which is 5 crore rupee. 25 lakh our total outflow. If I sold on 31st December 2019, that time is 5 crore value. Assume market corrected today 10%, the 5 crore could be 4 crore 50 lakh rupee. Every asset class is having market risk. Not even a single asset class there is no market risk. Every asset class is subject to market risk, whether it is a gold, whether it is a real estate, whether it is a mutual fund or a direct equity or anything. Suppose somebody invested in the mid cap. For example, Franklin Prima, because available period only, these 3 funds there for 25 years. Somebody invested mid cap, last 10 years they put 1 lakh, 1 lakh, 1 lakh, 10 years, 10 lakh rupee. If you see DSP mid cap, which is 28 lakh rupee, Franklin Prima is 27 lakh 90,000. In a longer duration, when you see maybe shorter duration, one will be 1 lakh 30, one will be 1 lakh 80. But if you see 10 years, 15 years and all, the difference is narrowing. If you see 10 years, Aditya Birla mid cap 28 lakh, Axis mid cap is 33, DSP 28, again 28, 29, 29. So somebody, what will happen because of the rating, 5-star rating, 10-star rating, 20-star rating will be there. People try to go for a 5-star ratings. I sell today some 5-star rating, tomorrow I will buy another 5-star rating because today this is not. I suggest you to ignore all those ratings, select the quality fund house and select the quality, people and be with them. When you return, nobody is giving you the return, market is giving the return. Intermediaries, what we will do, ensure that your documentations are good and travel with you. And then what will happen? Any emergency, somebody needs to be there to take care of our investments. For that only you need people. Otherwise, you don't need anyone. You can invest direct platform because mutual fund is having direct, also regular. Assume if you are investing in HDFC top 100 direct, the expense ratio could be 1% or 1.1. If you are investing through intermediary like me or others, maybe some banks, then expense ratio could be 1.7 or 1.8. The difference of 0.8 or 0.9, they will pay to the intermediary. What is the value addition these people has to give, are including Krishna Capital? You are there in a right path and you are not taking the decisions which is not good for your wealth. That is very important. When markets falling, we don't invest. When markets are going up, people will invest. We have to tell them don't invest. That is very, very important. So somebody invested Franklin Prima Fund, which is a mid cap, 25 years today, which is 7.8 crores. Can you believe this? Just I shared to mutual fund officers. Even they are thinking, is it happened this much? But how many people are holding for 20 years, 15 years and all? Because in the middle income group, need will come, we try to take the money out. Maybe I saved for 3 years. I made 20% return, I removed. I made 20% loss, then also I removed. I don't travel for 10-15 years like real estate or gold because that is a faith will be there. Whenever coming to the capital market, we have the faith to sign the balance sheets, but we don't have the faith to hold the asset class. That is the biggest problem. So here, if you see the Nippon growth fund, that is, it was a Reliance growth fund before, aggressively, it is a mid-cap fund. If you invested 1 lakh every year for last 25 years, you can see the number 9 crores. Can you believe this? How many people got the benefit? Very, very few people, like maybe Rakesh Jujunwala or maybe Damani or maybe all these people, Arshad Mehta, all these people got the benefit. Arshad Mehta not in the picture because there is no governance. The quality there, governance there, we will be there in the system forever. Only God calls us, we will go. Until that, we will be there in the system once we are practicing ethical way. And if you see, come to the professions of accountancy or chartered accountancy, how many people are filing the income tax return? I was checking yesterday, there's some data. Maybe it is available, you know, tax collection, revenue collection since 93 available in the website. We collected recently 27 lakh crore, both direct and indirect taxes. If you see exactly 7-8 years before, it was only half of that we collected. Whether GDP 5 trillion, people are not believing it will happen 5 trillion or 10 trillion. It maybe people think like it is like a joke. And we will make it. We means all put together, you, me, our generations will make it to happen. Because, you know, we are growing such aggressively because of the knowledge built. Our investments are our children. We invest mostly for the knowledge building only. India never took any patent historically for anything. Maybe America took patent on many things. Even they were trying for neem, trying for haldi, that is maybe turmeric. And we never took patent because, you know, it is for the universe. That's all, you know, we will say always, whatever we doing it for everyone. But now after seeing the Western country, we are started to take the patent because, you know, otherwise we have to pay royalty even for the neem, even for the turmeric. So if you see 400 years, 1000 years before the Mughals came to India, everybody came to take from India only, not to give it to India. Whether we have taken anything from any other country, no. We try to give always. In 60s, we exported doctors, and 70s also same thing. 80s and 90s, we exported computer engineers or engineers, and then nurses and teachers. We are always exporting the knowledge, but for that we are getting some payment. But we are investing most of the time on knowledge only. Even take for example, what is the biggest expenses what we have? One could be education, second could be medical. Anything else, if you see what we are spending for our food, if you see last 20 years for your son or daughter, what you spend for 20 years, what you spend for the food will be nothing compared to the education expenses. That is, we are following the Western way. So everybody came to India to take something from us. After giving, if you go to British Museum, you can see everything there, what is looted from India. You can see one temple door, you can see Raja's chair, you can see everything will be there. Still we are giving, we are ready to give. Even COVID, we are proving that we can give. We don't want, we wanted to give only. So are we getting the benefit of what is Indian capital market is giving? We are not getting the benefit. Reason being, out of 280 lakh crore, from 140 become 280. We crossed 100 in 2014 November. Today maybe 2,60,000 crores. This jump happened. We are not getting benefit. Two segments are getting. One is the promoter, second is the FIIs and FDIs. They have at least 75% share of the total 100 of Indian market capitalization. The balance 23 or 24 direct institutional investors and others, public. If we see public, if we remove all the bigger picture, bigger names, we will be just 4%. We are using every single product of Hindustan Unilever. We are using Gillette product. You name the product we are using, but we are not part of the capital market. Why we stress mostly out of the mutual fund? Somebody is there, professionals are managing the fund. Even somebody is holding any diversified equity fund for 7 to 10 years. I did not see a single scheme lost money. Single scheme, I did not see personally. A diversified equity fund, maybe a large cap fund or a mid cap fund or a small cap fund holding for 10 years. I did not see a negative return personally. So after that, I zeroed into only the mutual funds, no direct equity, nothing else, only MF is MF. Most of my assets only in the capital market. I don't have any deposits also. This is a huge opportunity. Please make use of it. That's the main request. And any questions you can ask us.
Sir, you have some question that came up at the start. I just shared that Excel sheet.
Okay, it is for me or madam?
It seems any one of you
Anybody
can
can
answer.
answer, I will answer. No issues.
Is my Excel sheet visible, sir?
I can see, sir. I can. Can you please tell us how to interpret the number of returns generated used for our investment decision making, especially the returns profile across different time periods? It's a very good question. The first one, What is very, very important here before investments decisions, any investment decisions, even investments for educations, last time also I mentioned it is subject to market risk. Maybe I wanted to put my son or daughter, maybe they wanted to go for any studies. I don't know what will be the outcome. First thing, they have to qualify. They have to pass maybe 10th standard or +2 or a degree or anything. After completion of the course, whether they will get the employment. Maybe I may pay 10 lakh rupee, 20 lakh rupee for education. Whether will they get the same amount what everybody is getting? So that is also subject to market risk. That is also market cycle. Somebody got a degree in 2008 or 9, especially the IT degree, whether it is a computer science or a BE computer science or BTech. Offer letter were given by Wipro. No employment confirmation given. Offer letter was given. But if we see post-COVID, everything is changed. So even come to the investments also the same thing. You have to have an asset allocation first and jot out your requirement. Maybe my requirement emergency corpus, medical requirement, and also my higher education or children education, or maybe daughter's wedding, or my retirement, or I want to visit every 3 years. I want to see all India because India is expensive than even many other countries. So if I want to see India, I should have money. So keep the money. When we are having very good health, we should see. If we spend only, economy will grow. That's what I will say. Live today, retire also rich, live also rich. How we can retire rich? By investing correctly. So answer to the questions here, different asset classes. If you see somebody bought an apartment, I told you across India it delivered below 11%. If somebody bought gold, that also delivered 11%. Liquidity is much higher in the gold than the apartment. We can't sell the apartment as it is like that. If you want to sell apartment at 30-40%, you have to get the lesser amount from the buyer. If it is gold, you can get. So then if it is coming to apartment versus gold, gold is better off than the apartment. Liquidity is more. Suppose my daughter wedding is next week or next month or next year, can I buy gold today? No, I have to keep my money only safe shorter duration funds or liquid fund low duration, because requirement is the next 6 months or 1 year. I have to keep my money only in a shorter duration funds, not in the equity, not in land or anything. So the time period supposed to be defined before investments. If an investment is for the purpose of retirement, you have 10-20 years, you can take allocation in equity more, or maybe gold, where whatever the asset class you have the faith. If you have the faith only in gold, buy gold, hold it for 10-20 years, you will make the return, because faith only derives the return here. If I don't have the faith, I buy, again I sell with the losses. And the second questions, I had been investing mainly through IPOs. I witnessed most of the time the share price with premium fixed for IPO is higher and opens the market. Okay, I will tell you, I am since in the Arshad Mehta time, I am an investor. If you see, for example, before it was quote 10 rupees the issue price, and it will quote at 40, 50, like that it will be quoted. The people make 40%, 50% return, in the listing day itself they will make those days. But if you see historically, you take from NSE website, you can go IPO return, maybe historically last 1 year, 3 year, 5 year, you can see that available data is available. Now before listing itself, we can take the recent example of LIC IPO. Even they gave it the discount, because when markets are very good, sentiment is very good, people try to come and buy. Sentiment also plays a vital role, like a fundamental will be there very good, but the sentiment is not very good, we sell that product, so it will come down, whether it is a gold or anything. Sentiment supposed to be good. So getting into IPO, will I make more money? Personally, I feel no. My personal experience, not that I lost money or I made money. You identify the quality companies. Quality companies, the best promoter, corporate governance, top line is growing, bottom line is growing. The product which is for the future, not for today. Whether they are the market leaders in that particular area, wherever that product they are selling, these are all the companies we have to own, and they are investor friendly. If the corporate governance is there, not there, everything is there, ignore them. One day or other we will suffer. So corporate governance is important. Promoter supposed to be very good. both are there, but the product is they are selling black and white TV. Again, we are supposed to ignore that company also. It's supposed to be the feature oriented. So don't go behind the IPO. I can give you one example. I know Mr. Gopu is no more now. He is a investor. He was also in Bahrain. He bought some 260, 270 companies from 78 to 2002. I came to India in 2004. He was always applying only IPO. Maximum 10,000 rupees he invested, maximum. Whether when he came back to India, maybe majority, maybe I can say 3/4 of the company Satyanas, nothing was there, but 1/4 was survived. Out of 1/4, he is holding ITC, he is holding, Asian Paints. His portfolio is much bigger, but only thing, it was in a paper format. He was holding everything. But when it comes to our digital world today, we buy IPO, good company, bad company. We try to sell the good company, hold the bad company. Even if you see the journey of last 20 years of the investor, normal investor, when markets are going up, we try to sell the all quality, booking the profit. We never book the losses. We try to hold all the crap in our portfolio and say, capital market is not lucky to me, not favoring me. And another question is,
Those were the questions.
my question. Yes, sir. Yes, somebody can read, sir.
Which one, sir? The second one, sir. I have invested.
The second one I addressed it.
Okay. So the third one. Do you think it's worthwhile to invest in LIC Jeevan Umang plans and LIC?
My question is there, Selva. My question is, don't we have a cross-check governing body to monitor SEBI and
Governing body, madam, actually, it's a very good thing. Last time also similar. My question is, don't we have a cross-check governing body to monitor SEBI, fix them, held them responsible for the type of failure?
Yeah.
It is happening consistently, madam. This is happening consistently. Even if it is happening consistently, that the chore will try to find a new way to perform something. Recently, we can see, front-running cases also. Can we 100% say it is not possible in future? Nobody can say no fraud will happen in future. It is keep on minimizing. If you see 20 years before, 25 years before, every week one finance company will be exploded. Every week, I'm telling. Every week one finance company will be exploded. It will not be that. They will try to collect the money. But slowly, which is reducing. And they are also, caught and they're all punished. You can see all those things. Can we eradicate completely? It is not possible. Nobody can eradicate in the world, because controls and checks will be there always. They try to put more and more control. You can see so many regulations are keep on propping up, amendments and all these things are coming because of all those reasons only. But can we say whatever, tomorrow I see the balance sheet 100% genuine? Anybody can say no. Whatever I say, I go to the doctor, I am cured 100%. Nobody can tell that. Here also the same thing. Yes, regulators are taking their own course of actions. They are doing the justice and they are penalizing the people. At the same time, tomorrow will not come. Nobody can guarantee that. It might come. Maybe the quantum will be lesser. If you see whatever they found in last 10 years, mind-boggling. People are not to India now. Vijay Mallya, if he managed his own asset, he can live like a king in India. But because of doing hanky-panky, now he is like living outside like an alien. That is a situation in India, new Bharat now. And tomorrow we see many problems, many punishments also we can see more. Once we punished more, automatically I want to see, 100 top people, especially those who did 100% wrong, they should be punished. That should come to the media so that people will be afraid to commit any mistake. I went to Singapore a couple of times. There is, we play. When we are playing, that they're asking actually, one question there. What is the punishment for the offense of second time punishment for the driver? That the question is, if I'm committing the first time driver knows the problem and he knows what is the punishment. The second time, if he commits any fault, the driver in Singapore, what is the punishment? I asked maybe 20-30 drivers we asked physically, and no answer. They said, I don't know, because the punishment is so severe in the first time itself, they don't dare to commit the second time. So we should have such a punishment so that these things will come down. Maybe somebody is coming out by killing Rajiv Gandhi. Can you believe this is happening? It should be something, the punishment is supposed to be so severe, they should not think of committing the second time any mistake at all. And do you think it is worthwhile to invest in LIC insurance? Madam, you can do your own, you're all finance professionals. Normally, I discourage investing through insurance companies. Insurance is separate, investment is separate. For example, maybe I took the policy for 25 years. For example, I paid a premium for 6-7 years. I paid the premium maybe 1 lakh for 7 years. I unable to pay or the 8th year. What will happen? Can I get my 7 years premium back or 7 years premium plus profit back? No. So I want to keep my money with me. I want to manage so that I will not incur any huge loss. Suppose if I paid 8 years premium, if I want my money back because of some emergency at my home, my first year premium they will not pay. The balance 6 years they calculate the surrender value, they pay X percentage. If I put my money in bank FD, by having the term insurance, my insurance will be there, my money also with me. So I suggest you think twice before investing through insurance companies. If you feel it is attractive, invest. Otherwise, personally, I discourage that one. Have your term insurance, have investment separately. If you like only postal saving, put the money in postal saving. That will give you 6 to 7, 8%. Where your money, anytime you can ask, they will give you money. Otherwise, you have to have the commitment of 25 years, 20 years term. After you pay all 20, 25 years, then only you will get some 5-6% from the insurance companies. And which is good portfolio in MF? Should one buy large, mid, small cap? And which is also a very good question, whether to go for a large cap, because every asset class having its own risk. Assume, for example, if I invested in 2008, you asked me this question. It came to me, sir, I have a 10 lakh rupee, I want to
Sir, your audio is lost.
₹1 lakh in small cap. In 2009, it became 2,50,000, 75% crashed. Maybe my intention is good, timing was wrong. You understood? So before investing, whether it is a large cap or mid cap, land or small cap, anything gold, you see the time frame. My investment time frame is long term, at least for 7 to 10 years. And today market is trading at cheaper. If you see Arshad Mehta time, market is trading at 30 plus PE. 2020 December, we are trading at again close to 30 PE. Even last year also we are trading at 30 PE, and today we are trading around close to 20-22 PE. And post subprime, that is in 2009, we are trading at 10 or 12. We are not ready to invest when market corrected heavily. Even recently, April 2020, when market crashed, we started to pull the money out, which is not the way in the capital market, or maybe in the real estate, or maybe in the gold also. If the gold price from 6,000, if it comes to 3,000, we try to grab the opportunity. When it's coming to the capital market, what we will do, we try to take the out with 40-50% losses. My suggestion, you invest here when market is falling. Even if you wrongly bought, as I told you, even if I gave you something at 2008, when Sensex was 20,000, I gave you 10 lakh rupee large cap or mid cap. If you are holding now, last 12 years, which is 3 times now, Sensex is 54, 55. Again, 10 lakh become, 30 lakh rupee or 25 lakh rupee. Only holding is the mantra here. If you bought the quality, please hold them. Suppose, for example, if you are confused which one to buy, whether to large cap, you want to take extra return you want, whether to buy a small cap or a flexi cap. If you buy the flexi cap, you don't need to do anything. The fund manager will do whether large cap or mid cap or small cap, or what is the percentage they have to hold large cap and mid cap. So flexi cap will solve you the purpose. For example, if you invested in HDFC flexi cap, just example, I'm not recommending again. Without doing anything, And today, if you see, which is like 10 rupee NAV become 1,000 rupees. It is 100 times. And so, if you are not equipped to buy which cap to buy, then go for a flexi cap. And does it need very expert knowledge for investment in options and futures? Is excellent questions. It's a very good question. Options futures normally, which is for hedging. It is not for investments. If you see the options and futures contracts itself, it is in India 3 months only. Current month, next month, near month, and the following month. 3 months will be there. And the futures, suppose if you are buying a Tata Steel today, assume 1,000 rupees share price. Futures could be 1,008 or 1,010. You pay 1% or 0.8% extra because it's a hedging instrument. Because you pay pay 20% or 25% as a margin. You don't pay 10 lakh rupee, the full amount what you buy for the stock. You pay here only requirement for 2 lakh rupee. Yes, sir.
Sorry, sir.
Hello?
Sir, the last question for last 10 seconds, your voice got muted, sir.
Okay, I will repeat. For example, you wanted to buy a Tata Steel, for example. Assume Tata Steel share price is 1,000 rupees. The contract is 100 rupee. Assume it is 100 rupee or 1,000. You assume one contract is 1,000. Share price is also 1,000. If you pay 10 lakh rupee, you can buy 1,000 shares of Tata Steel. But you are exposed to Tata Steel. If falls up 10%, your value will become 9 lakh. If it goes up 10%, it will become 11 lakh rupee. What is the future? Why we are buying future? If I'm very aggressive, I will buy future. But normally, futures is a hedging instrument. Normally, it is used for hedging only. But people will pay for aggressiveness. They try to speculate or gamble, whatever they can call. So assuming what will happen in future, 1,000 rupees in future price could be 1,007 or 1,010. If it is 1,010, you pay 10 rupee, that is 1% extra. That is a premium you paid extra for the future. You pay only 2 lakh rupee as a premium. That is, margin will be 20%. You pay 2 lakh, but your exposure will be 10 lakh rupee. Assume you gave 2 lakh, you collected 10 lakh rupee worth of Tata Steel futures now. If market crashes 20%, market means Tata Steel crashes 20%, within same hour, your 2 lakh is wiped out. Because your exposure is 10 lakh rupee, you gave a margin of 2 lakh. So options and futures, it is good for hedging. And especially in the investor awareness program, I try to tell the people don't get into any derivatives at all. Any derivatives other than hedging. Assume you are holding a portfolio of 10 lakh rupee, mutual fund portfolio or PMS portfolio or any equity portfolio diversified. If you wanted to hedge, use the Nifty futures. If assume your market will fall, then instead of selling your portfolio, sell Nifty futures. Maybe 10 lakh rupee, maybe 50% you want to hedge, sell only 50%, 5 lakh rupees worth. If you want 100% hedge, only for 100%, so that the taxation for your existing portfolio will not come. You are not selling the portfolio, you are temporarily hedging it. That's it. So my suggestion in IAB, I suggest you don't invest, don't speculate in the options and futures.
Those were the questions. Ma'am, over to you. Thank you so much. Ma'am,
You're welcome.
Over to you.
Any other questions?
No, so those are the questions. If there is any question that came up to our mail, we'll share it to you mail so you can respond it in time.
I will respond, sir. Sure, sir, I will respond. Sir, market is very abundant. Everybody can fish. Everybody will get the benefit. Only we have to be part of the market. If you want to learn something, I have to be that person. I have to be with that society. I have to be that community. Or maybe, if I want to learn something, I have to be associated with that. Similarly, here also, if I want to make something, we have to be with the market. Then only we can get the benefit. Thank you very much. Thank you.
Thank you very much, sir.
Thank you, ma'am. Thanks for the opportunity given. Hope cover the basics. I don't know how far it will be useful, but have a good evening. Thank you.
Thank you, ma'am. Thank you very much, Ms. Vijayalakshmi Yanmantram and Sri Satyanarayan Yanmantram sir, for taking your time out and enriching our members about financial planning and inspiring us to be part of capital markets and getting the benefits out of it. So thank you very much, and on behalf of SIRC of ICAI, I wholeheartedly thank both the speakers for their valuable suggestions and inputs to our members. With this, we conclude today's session. Thank you.
Thank you.